Hi students, welcome to Sunil's tutorial. I'm Sunil Midwani and today we'll be doing this chapter called as personal investment. We're going to do question number 15 today. We're doing question number 15 in the books of Mr. Irwin. In the books of Mr. Irwin, the following transactions of purchase and sale of equity shares of ASPI Limited, the shares have paid a value of 10. So that means you are doing investment in equity shares of ASPI. Investment shares of ASPI Limited. Right, let's start. They said that on the following dates you have purchases. The year ends on 31st March 2002 and 31st March 2003. Let's start. Let's make the format date, particulars, number of shares, cost, date, particulars, number of shares and cost.
You don't have a dividend account?
No, you don't need to have. You can make a dividend account if you want. Wait, I will show you with dividend. I was going to make a dividend account separately. You can make it in this also. So we'll do it with dividend in the same. There are two ways of doing this. You could make a dividend account separately, or you can show it here only. We'll do it with a single account. Now let's start. Where's the sum? On 1st Jan 2002, 1st Jan, number of shares purchased is 600, right? So to bank, you have purchased 600 shares at 20 rupees per share. So that is going to be 12,000, right? Next, then on 15th March 2002, you purchased 900 shares. To bank, you have purchased 900 shares at a price of 25 per share. Someone please tell me how much is that?
22,500.
22,500. Right? Then on 20th May, that's it. So in the current year, you have to close the books of accounts on 31st March. Tally this. Nothing else happens here. So this is 1500. This is 500 for 34,500. This is 2002. 31st March. Tally the account. By balance carried out. So this is going to be 1500 and 34,500, 1500 and 34,500. Okay. Now, name this down here. So 2002, 1st April, to balance brought down 1500 shares, 34,500. Okay, let's move on ahead. On 20th May, you have purchased 1000 shares at the rate of 22 per share, right? On 20th May, to bank, you have purchased 1000 shares at the rate of 22 per share. So that's going to be 22,000. Okay. Next, on 25th July, you have received bonus shares of 2,500 shares, right? On 25th July, you have received bonus shares of 2,500 shares. Bonus, that means that you didn't have to pay anything for it. So So the cost value of it is going to be nil. Next, they've said that after that, on 15th September, a dividend of 3 per share was received for the year ending 31st March 2002. So you have received a dividend of 3 per share, right? So this will be on the credit side, 2002 on 15th September. You're going to be receiving dividend, money is coming in, so this is going to be by bank. Now, your opening balance was 1500 shares, right? On 1500 shares, working out 1 dividend. You have 1500 shares as your opening balance. The face value of each share is 10 rupees, and they are saying that, okay, you don't need to, they haven't given you percentage. They are saying that 3 rupees, so 4500 is going to be your dividend. 4500 is going to be your dividend on your opening balance. Now in the current year till date, you have 2 purchases. One, the 1000 shares that you have purchased, and 2500 bonus shares that you have received. You do not get dividend on the entitlements that you have received in the current year. So dividend on current year, from open market I have purchased only 1000 shares, and 3 rupees is the bonus on that, so that is going to be 3000 rupees. Dividend for the previous year will go in dividend column. Dividend that is made due for the current year will go in the cost column. Fine, do we get this thing clear? So dividend of previous year is in the dividend column. Dividend for the current year will go in cost column. Fine. On bonus shares you don't get dividend in the current year. You receive bonus this year, that means you have already received entitlement on it in this year. So you will get dividend for this in the subsequent year. On 12th November, the company made a rights issue in the ratio of 1 share for every 5 shares held on a payment of 20 per share. Let's do the working note. Held rights issue. The company made a rights issue of equity share in the ratio of 1 share for every 5 shares held. Now as at the moment you had 1500 shares as your opening balance, you had purchased 1000 shares and another 2500, so you have 5000 shares. Guys, that means your rights issue
600.
1000. Your rights issue is going to be 1000. So you are entitled to a rights issue of 1000 shares. Right? Now, he subscribed to only 60% of the shares. So, subscribe rights issue, you are subscribing only to 60% of the shares that you are entitled to. So, you are going to subscribe for 600 shares. Fine, do we get this thing clear? Okay, once you have this, you are going to subscribe, that means you are going to buy these shares. At what price you are going to buy these shares? At 20 rupees per share. Buy, debit what comes in. On what date is the rights issue? The rights issue is on 12th November. You are going to buy it. So to bank, you are buying 600 shares. At what price you are buying? At 20 rupees per share. So that's going to be 12,000. Okay. Now, he renounced the remaining shares on the receipt of premium of 3 per share. Now I've told you that whenever there's a rights issue, you renounce the rights issue. That transaction is between you and the third party. Since the company is not involved in it, you'd never record that transaction. Right? Let's move on ahead. Shares are to be next. You have on 20th December, 1500 shares were sold. Debit what comes in, credit what goes out. On 20th December, 1500 shares were sold by bank. 1500 shares have been sold. At what price have they been sold for? At 22 per share. Someone please calculate. 33,000. Okay. Now when you sell, you have to calculate the profit or loss. Working note 3. Right? Now, the total shares that you had before the sale transaction. The total shares that you had before the sale transaction is 5,600. So the number of shares you have is 5,600, and their cost. Someone please add these three figures: 34,500 plus 22,000.
65,500.
22,000 plus 12,000 minus 3,000. Right? 65,500. You are selling 1,500 shares. So what should their cost be?
17544.
17545.
Right? So your actual selling price is 33,000. So you made a profit. Someone please tell me how much is the profit you made?
50,455.
50,455. Profit will come on the debit side. So this is on 20th December to P&L. This is going to be 15,455. Right? Next, again you sold on 1st Feb. Sold on the credit side. 1st Feb. By bank. You sold 1,000 shares at 24. You sold 1,000 shares at 24. That's going to be 24,000. When you sell, you need to calculate the profit element. So working note 4, number cost. Right? Now before the date of the sale, you had 5,600, out of which you had finished selling 1,500. 4,100. Someone get me the cost.
4795.
47,955. How did he get the cost? He added 34,500 plus 22,000 plus 12,000 plus 15,455 minus 3,000 minus 33,000. Right? Now you are selling 1,000 shares. So in that case, what should be the expected selling price? 11. Actual selling price is 24,000. Right? So how much is the profit that you are making?
12,304.
Right? Now, this is going to be 1st Feb to P&L 12,304. Right? That's it. Tally. Someone please let me tally this. This is 3,600.
5,000.
5,600. 31st March. My balance carried out. How much is it? 3,100. And the cost?
96,259.
96,259.
Difference is 36,259.
This is 4,500. This is 4,500. This is 31st March to P&L 4,500. Right? That finishes that sum. We'll stop this here for the day. Thank you very much.